Hello, Michael Shotnik with Sierra Pacific Mortgage, here to talk about a type of mortgage that's had a bad rap over the past kind of couple decades here, and that is reverse mortgages. Due to predatory lending and/or the exuberant expenses that were charged to consumers, reverse mortgages ultimately have a bad reputation. However, in the past few years, through federal and state regulation and insurance, a lot of these issues have been addressed, and I do believe it can be a really good product for the right person. What is a reverse mortgage? And pretty simply put, it's the opposite of a traditional mortgage. So with a traditional mortgage, you're taking your hard-earned cash, putting it into the home, and really turning it into home equity. With a reverse mortgage, you're doing the exact opposite. You're pulling that equity out and turning it into cash. To be eligible for a reverse mortgage, there's really a couple primary kind of focal points, and that is, personally, are you 62 years of age or older? And secondly, is the home your primary residence? And then ultimately, how do you pay back a reverse mortgage? So when you're no longer the full-time resident of the home, you have a few options. You can write a check to pay the loan off, you can sell the home to pay the loan off, or you can allow the lender to sell the home to pay the loan off. One of the primary concerns of a reverse is who actually owns the home. Like a traditional mortgage, the home is only collateral for the loan, so the bank is not the owner of the home. You are the owner of the home. If you have other assets, the bank has no collateral, cannot collateralize those. Again, the only asset that the loan is collateralized against is the home itself. As far as the options you have with a reverse mortgage, first and foremost, if you have a mortgage payment, you eliminate the payment for the rest of the time that you occupy the home. If you have sufficient equity in the home, you can take a lump sum distribution. You can pull monthly payments from the home, so that can be a specific amount of time or indefinitely. Or you can do a line of credit. The line of credit is a really good way of having kind of an emergency fund there. And the unused portion grows over time. So it's a very dynamic way of kind of having access to the equity if you need it. In addition, the reverse mortgage product is a very powerful tool to coordinate with your overall retirement plan. And what I mean by that is there's a few different aspects. If you're living off Social Security and looking for a way to improve your quality of life, it can be a really powerful instrument to do that. If, let's say, you have a portfolio of investments, you're able to take maybe distributions from that and Social Security. However, timing is important on those distributions. What I mean by that, let's say that the market's down, probably not an ideal time to sell the investments and take the distributions. What you can do is, rather than pulling from your investment accounts, you can kind of create a monthly income stream via, say, the line of credit, opposed to selling those investments you have. And then when the market recovers, or it's a more optimum time to pull from the investments, then you can change your strategy on a real-time basis. And what that creates is really just longevity and security to your retirement. I'm always happy to answer questions and determine if a reverse mortgage is right for you. 303-800-4595, hit extension 3. Thank you.